Hi everyone, it's Alex King here at Session Capital Research. I'm the founder and chief executive of the business. I want to extend a warm welcome to everyone today. This is a very special webinar for all of our members here at the Tech Select Substack that we run. Well over 1,000 subscribers now, I'm delighted to say. And for those of you that couldn't attend live today, we'll post a recording in the service in a couple of hours' time. The purpose of the webinar is twofold. Obviously, one, we'd like you to see some other features of the service, so our pro members get one of these every week. But in addition, I wanted just to shed some light on how we do our work and run through some of the key aspects of the tech market that we cover. So I want to talk about the NASDAQ, and then we're going to run through 6 stocks, Microsoft, NVIDIA, and Intel at the sort of larger cap end, Cloudflare, Datadog, and MongoDB on the smaller cap end. Like all of our webinars, we're running this on a live open mic basis. So if you have any questions, points, comments, anything at all, things you agree with, don't understand, anything like that, then just open your mic and shout into the system. If you prefer not to use audio or you're not able to, then there is a question function in the webinar platform here, and also a chat function in the webinar platform, both of which are a bit steam powered, but they do work. But if at all possible, just use audio. So unmute yourself and shout. We run all of our subscription services on the basis that there are no dumb questions, no such thing as a dumb question. In my experience, and I've done this for a long time, the best questions always come from the people who think they don't want to ask the question because they think they're going to look stupid. I guarantee you, if you're here, then you won't have any dumb questions. And if you have a question, so will lots of other people. So please, please, please don't sit back. Any questions at all, just raise them. Okay, before we do any of that, I just want to run through a brief disclaimer. It's going to be on your screen now, and I'm going to read through it. So, disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in this webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in this webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Session Capital Research, its employees, agents, or affiliates, including the presenter of this webinar, or related persons may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Session Capital Research. Session Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, so let's take a look together at the NASDAQ. Now, a very strange market right now where if you care to look at the facts are pretty bullish. You know, the NASDAQ hit a low in October last year, tested that low a few times, and it's moved up very strongly since, despite which, if you look anywhere on social media, you'll find no end of people who are going to tell you that the market's going to go down and hard in 2023. If you talk to anybody on the street, they'll tell you there's a recession and a cost of living problem and a this and a that. And all around you, you can find bearish sentiment wherever you look, which is completely at odds with how the market's actually moved. And whether you're looking at the NASDAQ or the S&P or the Dow or the Russell 2000, anything, they're all up and strongly since the lows of 2022. Problem I think is recency bias. So because 22 was tough, and it was tough for many people who weren't prepared for it, then people can only ever think about stocks going down. And even when stocks are going up, everybody remembers what it felt like in April or August last year when stocks went up, only to then plummet once more. All our work tells us this time, this up phase is different, that we think it's a new bull market rally. In the NASDAQ, probably the final wave up of a cycle that in a smaller degree began at the end of 2018, last time that the Federal Reserve tried to reverse monetary policy. And in the larger degree, you could draw a chart that said this is the sort of final hurrah of the move up from the 2009 lows when QE first became a thing. So we think the Nasdaq has some good upside from here, pretty good upside, at least 30% probably. But after that, we think there's some risk building. So I want to run through how we do that work. There's many. We use technical analysis for index assessment, because technical analysis just measures price patterns. So you can do, there's many ways you can look at macro factors. You can impute from the bond market. You can look at liquidity flows. There's many ways to do this, but those are all inputs in our view, and the only output that matters is price. And so for us, if you look at, well, where are the indices and where could they get to, we prefer to use technical analysis. Now, this is the QQQ ETF, which is a good proxy for the Nasdaq index here. And we run this chart. We've followed the same chart in our real-time services for some years now. We start a 5-wave up pattern. We use the Elliott wave system, which is, you can make very complicated or very simple. Simple version is that impulsive moves, in other words, the with trend move, goes in 5 waves. If it's a up move, it's a bull market, 1 wave up, 2 down, 3 up, 4 down, 5 up. If it's a bear market, 1 down, 2 up, 3 down, 4 up, 5 down. Since 2018, we've been in a bull market, and so what we have here is a 5-wave up cycle from that 2018 low. And the reason that 18 low is important is because all through 2018, the Federal Reserve was tightening monetary policy, just as it did in 2022. Not as dramatically in 18, but similar sort of moves. So a reduction in the supply of money and an attempted hike in the cost of money. The Fed came under pressure from the incumbent administration at that time, and in the end reversed policy right at the end of 2018. Now, all administrations pressure the Fed, nothing unusual there. In this event, what happened was that reversal, and 2019 saw a big run up in the Nasdaq. So on the QQQ here, it ran up from 143 at the turn of the year, end of 18, to 200 and let me see, about 240 by just before the COVID crisis in early 2020. So you had, a significantly greater than 50% run up in the Nasdaq in just over a year, fueled by nothing other than monetary policy. I mean, you can't say that earnings acceleration in Nasdaq stocks were that strong at the time. They were up, sure, but nothing dramatic. That was simply the change in liquidity and the price of liquidity. We then get a big drop, wave 2, drop down into the COVID crisis lows. Wave 2s in this Elliott wave theory are very often a severe, fast drop. And like many others, we measure the amplitude of moves in these waves using the so-called Fibonacci series. Those of you who are mathematical will know that the Fibonacci series is a constant in nature. For stocks, it doesn't really matter if you understand Fibonacci's or not. Any charting program will do this for you. What matters is that large accounts trade according to Fibonacci levels. And so these red ladders we use, this is a retracement ladder. So in other words, a retracement just means a move back down whence it came. The green ladders are extensions, so moving up with the prior trend. So we get this wave 1 up, peaks just before COVID. We get a wave 2 down, and it terminates at what's called the 78.6% retracement of wave 1 up. That's a classic wave 2. We get a rapid reversal here in the COVID crisis lows. And why was that? It was 2 reasons. One, a flood of federal liquidity, as you'll recall, but also the Q1 options expiry. So at the end of Q1, the whole world was so bearish through Q1, had bought so many puts on the Nasdaq and everything else, that the hedging impact of those puts was really strong. When investors buy puts, market makers, dealers sell puts. So an investor buys a put, is short the market maker sells the put, is long the market. The market maker's job is to be so-called delta neutral. In other words, have no directional exposure to the market. And so if they've sold a lot of puts, they're long the market, they have to offset that by either selling stock or going short via futures or something else, but they have to counterbalance their long position by being short somewhere else to be delta neutral. When all those puts expired, the Q1 puts expired, you had a huge amount of furious short covering by market makers because once the puts expire, the market makers' long side, the sold puts, is gone, and they're short via their short hedge. And so they have to cover that to get back to delta neutral. And so in the early parts of 2020, you had a combined impact of a flood of federal liquidity coming in and rapid short covering by market makers. And that created a momentum move that then generated its own momentum, where you had levered momentum funds buying in, buy high, sell higher, perfectly good way to run money if you can do it. And then ultimately retail piling in as the NASDAQ climbed. So the NASDAQ peaked out in this huge wave 3 up, almost a 2.618 extension of the prior wave 1 up. And if that sounds like stock gobbledygook to you, don't worry, it's not complicated. People like to make this stuff sound complicated. It isn't. 2.618 extension means that you take the share price move in the wave 1, multiply it by 2.618, and then place the length of that line, if you like, at this wave 2 low. The important thing here is to notice that these wave 3s, a common termination level is the 1.618 extension of a wave 1, and the S&P in 2020 finished its wave 3 in 21, I'm sorry, are at around the 1.618 extension of its wave 1. Well, the NASDAQ went on to a 2.618. Now, this formed the top at the end of 2021, early 22. We called this at the time in our real-time services. How do we know that? Well, two reasons. One, it was a really extended wave 3 high, so there's a good chance it was going to terminate there. And also because, as you can see, we just got this inability of the index to push beyond that. So it tried, here in November 14th, this is a weekly chart, tried again the 21st, tried again later on in December, but just couldn't push up through that level. And so you can have reasonable confidence that that's a top. We then get the sell-off down through 2022. It troughs at precisely at the 61.8% retracement of this wave 3. And again, how do we know that that's a bottom? I will say we called the bottom a bit early. We thought it would bottom out at this 0.5, and it didn't. We were wrong by 1 Fibonacci level. So how do we know that was a bottom? Well, wave 4s often terminate somewhere near this wave 1 high. They can go a bit below, can be a bit above, but so it was getting close to the pre-COVID high. The 61.8 retrace of a big wave 3 up, not an uncommon place for a wave 4 to terminate. But the big tell was, look, it can't break through this level. So it tries in October, tries again in October, it tries again in December, January, and then it just takes off. This proves hard support. And so for all this stuff that you see about, the NASDAQ's going to plummet, it's all going to go to zero. I mean, anything could happen. Of course it could happen. But you'd have to say, well, this level here, this 260, we'll call it, in the QQQs, proved rock solid support all the way through Q4 of 2022. If we look at the move up we've had since then, I'm going to switch to a slightly smaller degree chart here, and I'm going to use the futures chart because there's more trading data with futures. This is a 4-hour chart. What we get here in the NASDAQ is, this is from the January low here, we get a 1 up, a 2 down, a 3 up, big wave 3, a 4 down into March, and a 5 up into early April. Now, April has sort of drifted down and retested these highs, and it's unclear right now whether the NASDAQ will sell off a little bit, which it should, inverted commas, because we've got a double top here. We've got a wave 5 high here that's terminated between the 61.8 and 78.6 extension of waves 1 and 3 combined. Again, sounds complicated, isn't. The point is that's a very common place for these final wave 5s to terminate. So there's a good chance, I think, that we get some weakness in the NASDAQ now, short term. But if we do, I would see that as just a shorter term sell down as part of this overall move up. Where will the NASDAQ get to? Well, again, just purely on technical analysis, then base case for us would be the NASDAQ, the QQQ should terminate somewhere between 420 and 460, let's call it, and smack in the middle would be 440 before a more concerted down move. And so that's a good level of upside from here if that's true. That's a good 30+% upside from here. And I personally don't believe that's controversial. The economy's holding up all right, better than people thought it was going to. Probably we're going to see the last of the rate hikes this time around. Probably rates will flatten out. Maybe rates drop towards the end of the year next year. Who knows? But they should stop going up. And the thing that depresses equities is the rates going up, in particular the speed of rates going up. Institutional investors have spent 2022 building stock positions and building them for a new inflationary and rate environment, in the knowledge that inflation probably will be higher in the next decade than it was in the last decade. Reason, more protectionism between economies, more tension globally, broken supply chains, and so on and so forth. And as a result, rates will probably be higher than they were in the last decade. Everyone can live with that, and institutional investors can live with that. It doesn't spook them. What spooks them is rapid rate hikes with no end in sight. So there's a good chance this NASDAQ is off to a new all-time high before then coming down again. And so this is the analysis that sits behind all of the work we do in tech. We're very conscious of which direction is the market heading. And if the NASDAQ is heading up, then probably Microsoft is heading up, Apple is heading up, Nvidia is heading up, and so on and so forth. So when we do our single stock analysis, we're always thinking about what's the direction the market's taken. It's unlikely that if the NASDAQ is going to moon, add 30%, it's unlikely that both Microsoft and Nvidia and Apple and Amazon are all going to crash. And so you constantly have to look at the market versus single stocks. Okay, before we go into any single stock discussion, does anyone have any questions at all, points they want to raise? I'm going to unmute everybody my side. Hey, Alex, you're on.
Yes, Alex, I have a question about the Fibonacci levels. Part of the understand. One part I don't understand is when I look at that, the 4 bottom is at the 618 extension.
Yeah, so retracement. Okay. 618
retracement. But then when I look at your previous chart you put on 21 March at that same September time frame, it was a 786 level. So it seemed like it should be the same level.
Okay, so walk me through that.
Okay, no, this was a previous chart that you put out back in 21 March. Okay, and it showed in that low around September of 22. It showed the low. It showed the retracement level at 786, not 618.
Okay. Can you send me that chart? Because I don't recall that. Was it the same time frame? Was it weeks and months?
No, it was not. This one goes back to September the 18th, and that goes back to May of 19. So it's not the same time frame. Maybe that's the answer.
No, well, I'd like to see it. So if you can, you don't need to do it live, but if you can snapshot it and send it over to me, I'll come back to you when I post the recording to this. I'll come back to you in comments to that, because that's a bit of a head scratcher. So send it over and I will comment on it.
Okay, so maybe you can answer this one. The other one, back in March, it was a 2 bottom of the second wave, and here's the bottom of the 4th wave. So maybe you just need to see the chart as well.
Yeah, send it over. Send it over. Thank you.
Will do.
It wasn't. I've just switched to the short-term chart on here. It wasn't. It wasn't a shorter-term chart, was it?
No, it wasn't. No.
Okay, look, send it over. And I'll send it over. I'll post it to the article later when I post the recording, and I'll comment on it then.
Thank you.
Okay, man. Thanks a lot. Anyone else have any questions, folks, before we move on to any single stock stuff? Okay, let's do a couple of things. I want to look at some fundamentals as well as some charts. So let's first of all look at Microsoft. It's the one of the strongest companies out there right now, and I want to step through the fundamentals as well as the stock charts. So there we go. Okay, so on your screen right now is Microsoft fundamentals, and I just want to walk through the sequence that Microsoft is showing. You can see from here why the stock had such a strong reaction to earnings. So for those of you who've seen this stuff before, we use a really simple table to measure the fundamentals of all the stocks that we cover. And it doesn't look like what you'll see from Wall Street, because our DNA here is not Wall Street. Our DNA here is buy side, very specifically leveraged buyouts. And so all of our work is prepared for investors who are investing capital, be it your own or third-party capital. This is not work that's designed by sell-side analysts who are trying to ultimately sell you securities. Okay, so we deal with the revenue line first. We just deal with quarterly revenue, and you can see, the fundamental problems that Microsoft sailed into between 21 and 22. So the company had a really strong late pandemic period. So revenue growth peaked in the September 21 quarter at 22% over the same period in the prior year, and then the subsequent 5 quarters through 21 and 22, you see the growth rate just plummet. So by the time we sail into the December 22 quarter, we are at only 2% growth versus the prior year, which is the lowest growth that Microsoft had put in for, this chart only goes back to 2017, but the lowest growth rate for a very long time. Microsoft was forecasting 3% organic growth for the March quarter, and it delivered 7%. So it had a positive growth swing of 4%, which is huge. That's a huge beat on their guide. I don't know what the Wall Street consensus was. We don't look at it. It's not important to our work, but we look at the management guide because that tells us, if we get a sense of is the management team generally aggressive or conservative with their forecasting, it helps you work out what's the company likely to hit or beat next quarter. Microsoft generally are cautious, but this was overly cautious, I think. So they delivered it's not 3%, but a shocking 7% growth rate. Now, 7% is still low compared to history, but the point is that, number one, the growth rate accelerated. So you'd had 5 quarters of deceleration, and here you had an acceleration. That matters to stock pricing. And 2, it just blew through the management team's own guide, and therefore what was in sell-side analysts' minds about that March quarter. On a trailing 12-month basis, Microsoft delivered at this point 8% TTM revenue growth. Now, trailing 12 months is a slow burn indicator. It takes longer to spin up and to spin down. So we're now at 8% growth. Gross margin, pretty good, 69%, similar on a TTM basis. Accounting margin, EBITDA, it's been sort of 50% forever, nothing to see here. Cash flow had gotten really weak at Microsoft by the December quarter. So typically you've been, in recent years, at or around 40% trading 12-month unlevered pre-tax free cash flow. That was down to 37% by December, which is still high, but not by Microsoft standards. And you'd had this big working capital outflow in December. What that means is they've been paying out people a lot faster than they've been getting paid themselves. It means payment cycles are stretching. Customer payment cycles are stretching. The cash flow margin didn't change on a TTM basis in this quarter, but probably cash flow margins will start to tick up for Microsoft in the coming quarters. Balance sheet still, completely impenetrable, of course, $66 billion of net cash. You believe that? And the order book at Microsoft also looks pretty good. So remaining performance obligation, if you're not familiar with that, it just means the total contract book that the company holds with its customers for all contracts that have been signed, whether they're due to be paid up front, whether they have been paid up front or not paid at all. And RPO is a great long-term measure to look at. What good looks like in RPO is that the total RPO value is a big number relative to trailing 12-month revenue, and here it is. It's about equal to trailing 12-month revenue. So TTM revenue is about $200 billion at Microsoft, and the order book is about $200 billion. And then you want to look at, well, what's the rate of growth in the order book compared to the rate of growth in revenue? The order book here is growing at just over 22%, and revenue is growing, as we know, at around 7%. Now, you can't read across from that all of a sudden soon revenue will be 22.5% growth. It won't. It doesn't work like that. These are long-term contracts. But what you can say is if the RPO versus the revenue number is big, then RPO is meaningful. And you can say that if RPO is growing faster than revenue, there's a good chance revenue growth will pick up. And if it's growing slower than revenue, there's a good chance revenue will slow down. You can also look at the trend in RPO growth. So the order book is still slowing. Growth in the order book is still slowing, whereas revenue started to speed up at least this quarter. So what we want to see for Microsoft, if you're long Microsoft or you're thinking of becoming so, then you want to see this growth in the RPO level out and start to move back up again. It's yet to do that. So this is a key element to look at. Most companies don't, by the way, produce the RPO number in the earnings release. They'll sometimes talk about it on the earnings call, but you'll always find it, for those who report RPO, you'll find it in the 10Q or the 10K. It's usually published a little bit later than the earnings call. Microsoft get theirs out quickly. Some companies take a few days, but it's always in the 10K or 10Q. It's sometimes in the earnings release. It's sometimes in the earnings transcript. So that's RPO. Valuation, stock's up since then. I catch the stock price today, but let's call it 307 for the sake of argument. So the company's now valued at around 10 times trailing revenue, 20 times EBITDA, 30 times cash flow, there and thereabouts, which isn't, frankly, too terrible a valuation. On fundamentals, you could easily buy into Microsoft today if you look into the long term. Let's take a look at Microsoft stock. Okay, now how we look at individual stocks is, these are for our long-term picks. We don't think that buy and hold is the best thing to do. We know that asset managers will tell you that buy and hold is the best thing to do, but that's because they manage assets and they get paid for the amount of assets they manage. So of course they want you to buy and hold. That's what gets them paid the most. Perfectly sensible. But for investors, if you're on the ball, then buy and hold isn't necessarily the best thing to do. The best thing to do is to look at the ebbs and flows of how stocks move and try to be in the stock while it's moving up if you're long, down if you're short, and try to be out of the stock when it's moving down if you're long, or out of the stock when it's moving up if you're short. So Microsoft, if you were long, this is how we think about it. We use a motif called the Wyckoff cycle. Didn't invent this, WYCKOFF, you can look it up. The idea here is that stocks are pushed around by large account investors in order to create returns from nowhere. And because, if you're moving tens, hundreds of billions of dollars, and you can't suddenly, sit around and hope that some stock, turns into a good earnings report, you need more certainty than that. And so if you have enough money, then you can cause individual stocks to move just by moving them around. At some point we'll post a video on this in the service, but essentially the Wyckoff cycle says that stocks are accumulated by large investors down at the lows. It says that once the large account investors are done building up a position at the lows, they'll sit back and stimulate a stock price response. And so that's the point at which you'll see earnings upgrades by investment banks. It's the point at which you'll see many stories in the press about why Microsoft's a great company. And at this point, you'll see late buyers come in. Smart buyers are buying down here around these lows. So Microsoft follows the NASDAQ chart more or less. And so from about September until about January, September 22 to January 23, it was sat between about 215 and about 240. And for a few months, you could pick up Microsoft stock between 215 and 240. We define this as our accumulate zone. This is a great place to be buying these stocks on these bottoms, where you've got time, weeks and months, where you can pick up stock on red days. You don't need to chase them up. You've got a bit of time. And then once this markup zone kicks in, at this point, late money is buying this stuff. Okay, people have suddenly cottoned on to the fact that the market's bottomed. Everyone's piling in. Initially this will be momentum funds, levered hedge funds. Later it'll be retail. So you just maybe now starting to get average retail go. Oh, maybe the market's going up. Just starting. As Microsoft climbs up here, and we think it will, you're going to see more and more retail get all excited. We do believe it is when Microsoft approaches a new all-time high, you can bet you'll see a stampede of retail at that point. Now, what you're seeing here in this chart, and we do this for all the stocks we cover, is a combination of 3 methods, okay? And the 3 methods help us determine when to enter and when to exit stocks. We've done the fundamental work. We believe that Microsoft is a long-term, high quality company. It's had some growth challenges through 22, sure, but it has probably the best CEO in the business. It's been cute with getting ahead of the story on AI. It doesn't have any revenue from it really yet, but it's got a great stock narrative. And we think this is a great fundamental business to own. And then our work then says, well, okay, when should you enter and when should you exit a stock? Well, let's go back to these waves again. Now, you don't know when a wave 1 is starting or when it's finishing. You can't really say. What you can say is, did a wave 2 finish? And with Microsoft, you got this wave 1, again, from that December 18 low to the early Q1 2020 high. You get a sell-off down to the 61.8 retrace into the COVID crisis, and then a move up. And so you could say that around here is a good time to start buying. And in our real-time service, we'd said, I think we said March 26 of 2020, we published an article saying buy, meaning everything. And again, how do we know? Answer, wave 2 reversal. So Microsoft then puts in this big wave 3 up. It peaks at the 2.236 extension of wave 1. You'll remember that the NASDAQ peaked at 2.618, so not quite the upside in Microsoft as the NASDAQ at large. You get all the downside though, so it retraced all the way down to the 61.8, retraced down here. And at this point, we labeled this the accumulation zone. You'll see us rate things at accumulate or buy at this level. For those of you who are pro subscribers here in Tech Select, if you click onto the service homepage and click on Pro Resources, you can get from there to all of our stocks ratings, the latest charts, and so on. For those of you who are not yet Pro members, you can always upgrade either Premium to Pro or from Free to Pro. Just go to your subscriptions and you can handle it. We now rate Microsoft at hold. It's in this markup zone. So we think the stock's going to continue to climb. We think that it can make a new all-time high, again, a wave 5 high, somewhere between the 61.8 and 78.6 fib extension of wave 1 and 3 combined, and translated into actual numbers. That means probably around $400 as a next high point. Could go higher for sure, probably won't be lower than 375. Let's call it 400 for a round number. Now, as we approach that, what we will be doing is starting to rate Microsoft at distribute, meaning sell. Not because we don't think the stock can't ever go up again, but because as stocks reach this wave 5 high, the risk is just climbing. The risk is that you're going to see a sell-off. And so buy and hold, well, why, if you can avoid it, do you want to hold a stock during a downturn? Why not just take profits when it's up at these high levels, and then you can always re-enter lower down. Now, of course, you can't know when a wave 5 is finished. You only know when it has finished, but you can know where it's likely to finish because these patterns are pretty good, especially for these highly liquid, high volume stocks. And so for us, you'll probably see us selling our Microsoft positions in staff personal accounts as we get to around this level. Okay, that's Microsoft. I'd like to talk about Intel as well. Why? Because it's a complete disaster area fundamentally. I mean, it's just in terrible shape. But the stock has started to do really well, and you often see this. I'd like to step through what's happening at Intel particularly. So I'm just going to open up the fundamentals right here. Hold on. Okay. So here on your screen you have Intel fundamentals. Now, you all know what Intel does. Big chip designer and manufacturer, a so-called integrated device manufacturer, not fabless. They have their own fabs or manufacturing facilities. And you also know, I'm sure, that Intel have had some problems in recent years. We can argue about why, but it starts with, I think, a lessening of the engineering function within the senior management team, a focus more on finance, and they've hit some serious problems in product design and in manufacturing. So product design, they missed moves to the so-called smaller process nodes. That just means chip geometry or number of distances between elements on a chip. The whole semiconductor industry functions according to moving to smaller and smaller so-called process nodes. And to do that is really expensive, risky. You got to get your design right, your manufacturing right. And Intel messed it up on a couple of occasions. They're not really recovered from a problem they hit in 2018, 2019, around the shift to the particular process node at that time, the 10 nanometer process node. And they've struggled ever since. You can see it in their numbers. So Intel, you can say, was growing at a reasonable rate back in 2020. So in June 2020, on a trailing 12-month revenue basis, they had 12% growth. But pretty quickly, the company was hitting problems. So they had 0% growth by June 21, a couple of growth quarters for the last of 21, negative 7% growth in March 22, then negative 22, negative 20, negative 32, negative 36 for the quarter. So this is pretty remarkable, really. This is in a stalwart of American industry. It turned in shy of $12 billion revenue in the March 23 quarter, compared to a peak of almost $20 billion in March 21. So the company is almost halved in size on a quarterly revenue basis in the space of only 2 years. I mean, it's pretty hard to do that. Margins are terrible. So gross margins have gone from a sort of steady state in the low 60s down to 38% in the most recent quarter. And again, that's a TTM basis. So that's a slow flywheel spin down margin. It's quite hard to crater your margins that fast. Accounting margins were down to 17%, TTM EBITDA margins, and cash flow is a disaster area. Right. So this is a business which just recently, as March 21, was producing 30% unlevered pre-tax free cash flow margins, and it's down to negative 42 in the quarter just printed. So from positive 30 to negative 42% cash flow margins, quite remarkable. The reason for that, by the way, is not only is the company performing badly, but they've had to spend big capex to get those factories in shape for the next production run, future process nodes, all those things. Balance sheet has gone from modest amounts of net debt, so $7-8 billion back in 2020, down to quite a lot of net debt now, $17 billion, nearly 2 times leverage in March 23. And 2 times leverage it's not a particularly big deal, but it is a big deal when you used to be at 0.1 times leverage so recently. So Intel on fundamentals has got a real problem. It's not pretty at all, and which makes the following all the stranger. Let's look at the stock price. Let's first of all look at what it did. I'm going to move on to a monthly chart here. So from the 2009 lows, Intel delivered 1, 2, 3, 4, 5 waves up, peaking at around $70, we'll call it, round numbers, early in 2020. And it then started to sell off, but it retested that high in 2021, as you can see here. Very common to see, by the way, a retest of levels like that, be it lows or highs. And if you get a rejection at that retest, then you can be pretty sure you're going to get a sell-off at that point. Ditto, if it's support down here, you get a rejection of breaking through support, good chance it moves up. So Intel, pretty interesting this, well, I think it's interesting anyway. So it moves up from about $12 a share to call it 70, and then it sells off really hard. But look where it finds support, a key Fibonacci level, 78.6 retrace of this move up from the 2009 lows to the 2021 highs. And this is my point about you don't need to understand Fibonacci's really. All you need to do is know that all of your chart programs, whichever one you use, will draw them for you. And you need to know that large account players trade to these. And again, if you doubt that, first of all, here's the reversal at the 78.6 retrace, pretty much to the dollar. Here's it retested. So it reverses in September last year. It retests that level in January, retests it in February, bounces off, and look where it hits resistance at exactly the 61.8 retrace of this prior move up. So we define the accumulation zone for Intel as between these Fibonacci levels, between $24 a share and $34 a share. And we figure that there's a good chance that institutions now are hoovering up stock. And to take a look at that, let's look at this, use this volume by price indicator. And let's start the clock at that second retest of the all-time high. Okay, so what you see here, this gray bars on the right are volume of stock traded at any given price level, not time slice, but at price. So you can see there's a lot of stock traded here, which was probably distribution. It was probably large accounts selling down stock at these levels. Now, the clock starts here in March 21. Okay, so any share sales here took place after this dotted line. We sell into what's called low volume nodes, not much in the way of volume between, let's call it $43 a share and $34 a share. But once we reach into between these two fibs here, you start to see volume really ramp. And it could be selling, of course, by institutions, but more likely it's buying. It's buying at a key technical low. And so we think that Intel will follow something of the same path as NVIDIA, probably not as dramatically. But if you look what happened to NVIDIA, okay, similar story, tighter time frame, similar story. Here's NVIDIA from the 2019 lows to the 2021 highs, dramatic move, $34 at the lows to $350 at the highs, so 10 times your money in the space of only a couple of years. It then sells off down to our old friend, the 78.6, retraces that whole move up, and it then moves up strongly. Now, I'm not sure that Intel will get quite the bounce that NVIDIA has had because it doesn't have as much of the AI narrative, or at any rate, Intel management team are not as good at exploiting that narrative. But I do think it will get a bounce up. So Intel continues to have awful fundamental financials, but the stock has, as a matter of fact, bottomed so far. It bottomed in September last year. It rechecked that bottom in December and in January, and it's moved up. Why has it moved up? Well, because markets always look forward. Okay, and so the market is figuring that, well, as Intel said, probably the worst of the PC downturn is behind them. Management guided to negative 22% growth for the June quarter, which, although terrible, is much less terrible than the current quarter or the last quarter. So what management is saying at Intel is things are starting to turn around. They're guiding to 38% gross margins again. They're saying the gross margin is not going to collapse any further. So the company is saying loud and clear to the market that they think that the bottom is in terms of rapidity of decline and so on. The other reason that Intel has reacted strongly is because of the CHIPS Act. So one of the things that's going on, as I'm sure you're aware, between the US and China right now is the reshoring of manufacturing from China to the US. So where so-called fabless chip companies, those that design their own chips but don't have fabrication facilities, much of that would have been outsourced to people like TSMC in Taiwan, SMSC in China and elsewhere. And increasingly, US firms are being told to reshore that manufacturing back into the US specifically, or US's allies, but specifically the US. And with that comes a couple of things: colossal capex from people like Intel, who have to build new plants. TSMC is doing something similar, but also the wind is behind these names. Basically, if you are a US semiconductor designer building in the US as well, then the wind is at your back from a stock perspective. So semiconductors, we think, as always, will lead the way up and out of the downturn. They already have. So that means stocks like Intel, NVIDIA, Micron, Marvell, many others. SMH is a useful ETF. SOXL is the levered version. We think that Intel can do really well off the back of the slowing decline of fundamentals, the policy support from the CHIPS Act, meaning reshoring back to the US. And then overall, again, as we said at the start, if the NASDAQ is going up, then it's unlikely that Microsoft, Intel, Micron, Amazon are going down. Probably the market will lift those boats as well. So that's Intel. So we've done Microsoft, we've done Intel. Any questions on those, folks, before we move on either stock or on the methods we talked about, or anything you like, really? If you think of questions, by the way, after the session, then just post them as comments to the article that you'll see, which carries the recording of the webinar. Okay, we're running a little bit short of time. Let's look at a couple more of the stocks we cover. I'm going to look at a couple of higher growth ones. I'm going to look at Dynatrace first and then Datadog. So I'm just going to call up the fundamentals on Dynatrace. 1 second. Okay, here we go. Now, if you're not familiar with Dynatrace, it's worth getting to know. Reason, it's a really, here we go. This is their website on here. Reason, it's a really super strong business, incredibly well managed. It sells mission critical software to enterprise customers. So it sells so-called observability or monitoring software. So big companies will use it to sit in the heart of the data centers to look across the IT stack to see if other software applications, bits and pieces of code soup, bits and pieces of hardware, make sure everything's working as it should. And if not, report it to the IT team or try and fix it itself. It's a really important element of enterprise software. Not very, doesn't have much sort of public appeal, but it's a really very good business. This is Dynatrace fundamentals. It's not really exciting levels of growth, but if you take everything together with the margins and everything else, it's a really nicely run business. So the company reports, December is the most recent report. They've not reported to Q1 yet. In December, they just started to show re-acceleration of growth coming out of the fallow period. So one of very few companies to do so. So the company peak growth was around 35% in June 21. It declined for those 5 quarters through to September 22. December 22, it puts in a slightly high growth quarter, 24%. TTM revenue growth rate at this point, 26%. So, good, not fantastic, but good. But then you get to the margins, right? 81% gross margins. They're really efficient with their variable costs. 25% trailing 12-month EBITDA. And then the cash flow is just really, really impressive. They get paid upfront for lots of their contracts. And because of that, cash flow exceeds accounting profit. Now, you don't see that very often with companies. You see it more often with software companies than most other things because they're able to charge upfront for these mission critical applications. So in a year where you had $279 million of TTM EBITDA, you have $366 million of TTM cash flow. And cash flow has been consistently higher than accounting profit, which is a really good indicator of quality of earnings. If there's more cash than there is profit, that's pretty good. You're getting paid up front and you're not paying out too quickly. Balance sheet, I've seen bigger balance sheets, but it's fine, $422 million of net cash. And then where Dynatrace is really impressive is the remaining performance obligation book we talked about before. This is the total order book. They have orders worth about 1.5 times the last 12 months revenue. And the order book is growing at around 21% a year, whereas recognized revenue is growing at around 26% a year. So overall, they have a lot of orders, lots of visibility. It'd be nice to see the rate of growth in the order book just pick up. That would give you a bit of air cover to assume that revenue growth was going to hold, maybe increase. But overall, really well managed business, lots of cash flow, super high levels of visibility on forward orders. That's 1.5x the trailing 12-month revenue again. And all in all, a really good business. Valuation, check the price today, but stock will be at around low 40s. And so the market's asking you to pay about 11 times revenue and a big multiple of EBITDA, but around 11 times revenue, which is probably okay. Let's look at the Dynatrace stock chart. Okay, switch to weekly. Okay, this will be a familiar pattern to you by now. So here's Dynatrace at the COVID lows, 2020. March 2020, it's around $17 a share. It puts in a big wave one up, peaking in October 21 at around $80 a share. So it more than 4x'd in the space of less than 2 years. It sells down to, you guessed it, the 78.6 retrace of this big wave one up. And then it's started to put in, as you can see here, 1, 2, 3, 4, 5 waves, smaller degree moves up. And we think that this can continue. And we think that Dynatrace can be in the $50 before too long at all, and ultimately go on to make new highs at $80 and beyond within the course of the next year or two. It's a really well managed business. It doesn't surprise too much, and we think it's a very compelling stock to hold. That's Dynatrace. Any questions on that, folks? We have 10 more minutes to go, so great time to take questions on any topics or points or anything you want to raise, anything about the service, in the UK too. Okay, then why don't we do one more? Why don't we do Datadog? So let me get the fundamentals here. Now, Datadog actually competes with Dynatrace to a degree. They also yet to report their Q1. Let's take a look at their numbers here. Okay, so this is another high growth business where we've seen growth decline. So as recently as March 22, the company was growing revenue at 83% a year on a revenue basis of about $1.2 billion for the year. That slowed. So the most recent quarter, December, was 44% growth, and the management team were guiding to 29% for Q1. Margins high, 79% trailing 12-month gross margins. Again, EBITDA margins high, 20%, and cash flow very similar to EBITDA levels. So low 20s, high teens, cash flow margins. Good solid balance sheet. Again, seen more impressive in my life, but just over $1 billion of net cash, and RPO good, not as good as Dynatrace, but they've got orders worth about 60% of the last 12 months revenue, and that order book is growing at a good 30%, so a good clip. So that's Datadog, and if we look at the stock chart for Datadog, this is struggling at the moment to get out of our accumulate zone. So our chart here goes from the 2019 lows to the 2021 highs. So it's delivered, let me see, from about 27 to about 200 return in only a few short months. Pretty remarkable. Retraces to, you guessed it, the 78.6 retraced this move up, and it's bumped along the bottom there quite a lot, all the way through March, April, and early May. It's bumping along there. We have the stock rated at accumulate. We think this accumulation zone between the 78.6 and the 61.8 retrace can hold, and we would expect to see this one move up really nicely as the market recovers. Okay, folks, so we've done the NASDAQ, we've done Microsoft, NVIDIA, Dynatrace, Microsoft, Intel, I beg your pardon, Dynatrace, Datadog, and before we finish up, I have a couple of things. So first of all, everyone here, Sun Chao, you have a question? I'm going to unmute you. Hold on one second. Okay. I think Sun Chao's gone. Okay. Never mind. Okay. So where was I? Just to thank everyone for being a member here at the Tech Select Substack. It's a great service. We really enjoy writing it. Substack's a great platform to be on. If you are a free subscriber here, that's great. You know, we really like everyone that comes and reads our free stuff. That's just terrific. Please share our work around any way you can think of across any social media, friends, family, colleagues, all over Twitter, StockTwits, wherever you can think of, just share the work. If you'd like to step up to a paid subscription, we offer 2 levels. Premium gets you regular earnings reports, fundamental and technical analysis report on each of the stocks we cover with price targets, risk management levels, and so on. We haven't talked about stop losses here, but you can see them on the screen right here. And then if you want to take out the pro subscription, it's a little bit more expensive, but it gets you one of these webinars per week where we zero in on a couple of topics, and we do live Q&A. And also you get standing access, 24/7 access to all of the stock ratings and stock charts we have for the tech stocks we cover. So again, just to run through, we have free subscriptions. If you're on a free, that's fantastic. Thank you. Share the work everywhere. Premium gets you the earnings reports, and Pro gets you the earnings reports together with 24/7 access to stock charts and ratings. And also with Pro, you get a weekly webinar of this ilk. So that's it, folks. We've done just shy of an hour. I want to thank everyone for showing up here and for being members here. The video takes a little while to compile, be about an hour or so, and then we'll post it in the service. And then think of any questions then, please do come back to us with written comments. Thanks, everyone. Speak to you all soon.